the ghost collateral, keeping the global market alive. Imagine you walk into a high-end restaurant. You order the finest steak on the menu, but when the bill arrives, you realize you've forgotten your wallet. To solve the problem, you give the waiter your watch as collateral. "You'll be back tomorrow with the cash," you say. The waiter agrees. But the moment you walk out the door, the waiter takes your watch and uses it as collateral to borrow a bottle of expensive wine from the bartender. The bartender then takes that same watch and hands it to a supplier to secure a shipment of spirits for the weekend. By midnight, your single watch is technically backing 4 different debts held by 4 different people. This is fine until you walk back in the next morning with your cash and ask for your watch back. The waiter doesn't have it, neither does the bartender, and the supplier, he just lost it in a bet. In the world of global finance, this isn't just a restaurant mishap. It is the invisible engine of the world economy. It's called re-hypothecation, but a better name for it is ghost collateral. Right now, trillions of dollars in global trade, corporate lending, and government spending are resting on assets that have been pledged, borrowed, and repledged so many times that if the original owner ever asked for them back at once, the entire system would vanish into a cloud of digital smoke. Welcome to the hidden plumbing of the global market, the stakes. Most of us are taught a very simple version of how money works. You work, you earn $1, you put it in a bank, and the bank lends it to someone else. It's clean, it's linear, it makes sense. But the real money, the institutional money that moves between Wall Street, London, and Tokyo, doesn't work like that. At this level, cash is actually a secondary player. The real king is collateral, specifically high-quality collateral like U.S. Treasury bonds. In the eyes of a major bank, a Treasury bond is better than cash. It's safe, it's liquid, and it pays interest. Because these bonds are so safe, the financial system has developed a massive appetite for them. But there's a problem. There aren't enough of them to go around. To solve this, the system started doing something clever and dangerous. It started using the same bond to back multiple loans at the same time. Step by step, how the ghost is created. Let's look at the mechanics. When a hedge fund wants to borrow money to make a big bet, they don't just ask for a loan. They go to a massive bank, Goldman Sachs, JP Morgan, or Deutsche Bank, and they offer collateral. Let's say they offer $100 million in Treasury bonds. The bank takes the bonds, gives the hedge fund the cash, and everyone is happy. But the bank doesn't just put those bonds in a vault. Under current regulations, they are allowed to take those borrowed bonds and use them as their own collateral to borrow money from someone else. This creates a chain. The hedge fund's bonds are now sitting on the balance sheet of Bank A. Bank A then pledges them to Bank B to cover a different trade. Bank B then lends them to a third party to facilitate a short sale. The same $100 million in bonds is now supporting $300 million, $400 million, or even $500 million in total credit. The original asset is still there, but it has been stretched thin. It has become a ghost, haunting multiple balance sheets simultaneously. The uncomfortable math. This is where the math gets uncomfortable. This process is known as the collateral multiplier. In a healthy, booming economy, the multiplier is high. Money flows fast, everyone is confident, and the ghost collateral keeps the wheels of global commerce spinning. It allows for more lending, more liquidity, and higher growth. But there is a dark side to this efficiency. The entire chain depends on one thing: the value of the original Treasury bonds staying stable. If the value of those original Treasury bonds drops even slightly, every single person in that chain suddenly has a problem. Bank C calls Bank B and asks for more collateral to cover the gap. Bank B calls Bank A calls the hedge fund. This is what's known as a margin call, but on a systemic level, it's a collateral squeeze. Because the same asset is backing so many different debts, a small tremor at the beginning becomes an earthquake by the end. The ghost collateral starts to evaporate, and when the ghosts disappear, the credit disappears with them. The hype versus reality. We often hear talking heads on news networks obsessing over interest rates. They talk about the Federal Reserve as if it's the only heart in the body of the economy. If the Fed lowers rates, the economy grows. If they raise them, it slows. But this is a surface-level narrative. The reality is that the shadow banking system, where this ghost collateral lives, is often more powerful than the Fed itself. You can have 0% interest rates, but if the big banks are afraid of the quality of the collateral they're holding, they will stop lending. In 2008, the world focused on subprime mortgages. We were told the problem was that people couldn't pay back their home loans, and that was true. But the reason the global system almost died wasn't because of the houses, it was because those mortgage-backed securities were being used as collateral in the re-hypothecation chain. When the value of those safe assets came into question, the entire chain of ghost collateral collapsed in a matter of days. The plumbing got backed up. No one knew who actually owned what, or whose collateral was real and whose was a ghost. The zoom out. Broader implications. So, where are we now? Since 2008, the world has moved away from mortgage-backed boasts and back towards safe government debt. But the underlying system, the chain of repledging, has only grown larger. We have built a global financial structure that is fundamentally fragile. It relies on the absolute perfection of government bonds. It assumes that the safe foundation of the world economy will never, ever crack. But what happens when government debt itself becomes volatile? In recent years, we've seen wild swings in the bond market that were previously unthinkable. We've seen flash crashes in the most liquid markets in the world. These aren't just technical glitches, they are the ghosts flickering. If the multiplier is 4 or 5, meaning every dollar of real collateral is backing $5 of debt, then a 20% drop in the real world becomes a 100% loss in the ghost world. The math is relentless. It doesn't care about policy or sentiment. Conclusion. The global market is not a solid fortress built of gold and brick. It is a vast, interconnected web of promises held together by assets that are being used by too many people at the same time. We have traded stability for speed and security for liquidity. We like to think that in a crisis, someone, the government, the central bank, can just print more money and fix the problem. But you can't print collateral. You can't print a safe asset that everyone trusts. Trust is the one thing you can't manufacture in a basement. As you look at the markets today, don't look at the stock prices or the headlines about the latest tech billionaire. Look at the plumbing. Look at the collateral. Because the most dangerous thing about a ghost isn't that it's there, it's what happens when you finally try to touch it and your hand passes right through. The question isn't whether the system can survive another crisis. The question is, when the lights go out and everyone reaches for their watch, who is going to be left holding nothing but a handful of air?